I want you to forget stock charts for a moment. Forget headlines. Forget what your portfolio did today. Instead, I want you to ask a deeper question. Why does the market keep going up, even when things don't fully make sense? Because if you look closely, something unusual is happening. Economic growth is slowing in many places. Debt levels are higher than ever. Geopolitical risks are everywhere. And yet, markets keep floating higher. This isn't random. This isn't luck. Machine underneath the market. Quiet, powerful, and mostly invisible. Pumping prices higher for years. Most investors never see it. They only see the result. Let me show you how it really works. At the center of this machine is liquidity. Liquidity is simply how much money is available to flow into assets. And contrary to what people think, markets don't rise because companies are great. They rise because money has nowhere else to go. Over the last decade, the global financial system has created enormous amounts of capital. Pensions, sovereign funds, insurance companies, central banks, all of them need returns. And all of them are forced to deploy money constantly. This creates a one-way pressure. When too much money chases too few assets, prices rise, even if fundamentals don't improve. That's the first engine of the machine. The second engine is passive invest. Every month, millions of people invest automatically. Salary comes in, money goes out, no emotion. Index funds don't ask questions. They don't care about valuations. They buy no matter the price. This means the biggest companies receive the most money simply because they're big. Not because they're better, not because they're safer. Just because they exist at the top. This feedback loop pushes winners higher and higher. And the higher they go, the more money they attract, That's not investing anymore. That's a machine running on autopilot. The third engine is cheap confidence. For years, markets have been trained to believe that nothing truly bad will be allowed to happen.
That if things get ugly, support will arrive. Stimulus, rate cuts, liquidity injections. This belief changes behavior. Investors take more risk, companies take on more debt, speculation feels rational. And as long as confidence holds, the machine keeps running smoothly. But confidence is fragile. It doesn't break when something goes wrong. It breaks when people realize protection has limits. The fourth engine, and this one is rarely discussed, is financial engineering. Buybacks, debt-funded growth, accounting optimization. Companies are no longer just building products. They're managing stock prices. When profits slow, buybacks accelerate. When growth stalls, guidance changes. When margins compress, adjustments appear. This doesn't mean fraud. It means incentives. Executives are rewarded for stock performance, not long-term resilience, and that aligns perfectly with a market obsessed with short-term results. The final engine is narrative. Markets don't move on numbers alone. They move on belief. Every cycle has a story that justifies prices: the internet, housing, emerging markets. Here's the uncomfortable truth. None of these forces are evil. None of them are conspiracies. Zero rates, and now transformative technology. Narratives give meaning to price action. They silence doubt. They make risk feel intelligent. As long as the story survives, the machine keeps pumping. They're logical outcomes of the system we've built. But systems like this don't reverse gently. They don't stop because people notice them. They stop when something interrupts the flow. Liquidity tightens, confidence cracks, or narratives fail to deliver. And when that happens, the same machine that pumped prices up can pull them down faster than anyone even expects. That's why understanding this matters. Not so you can predict the top, not so you can panic, but so you don't confuse momentum with stability. Strong markets don't mean healthy markets, and rising prices don't mean low risk. The hidden machine doesn't care about your entry price. It doesn't care about your timeline. It only cares about flow. And when flow changes, everything changes. In the next part, I'll explain what usually disrupts this machine and why the trigger is almost never what people are watching. Because by the time the machine stalls, most investors are still convinced it will never stop. That's all for today. I hope you learned something new. If you did, please like, subscribe, and stay tuned for the next video coming soon. And thank you for watching.